After another weak week, the S&P closed the year down almost 20%. But bonds did not do much better, and 10-year yields were pushed up from 1.5% at the start of the year to 3.9% last week. Bitcoin more than halved, while commodities managed to pick up 15 to 20% in 2022. Hello sector watchers, welcome to the show and a very happy new year. I hope you all had a good and festive holiday period, managed to stay healthy, and you're now ready for another year in the markets. This is the 157th episode of Sector Spotlight for Tuesday the 3rd of January, and I'm recording it on Monday the 2nd. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. As Sector Spotlight has been on hiatus for the last 2 weeks, I'm going to squeeze in both the seasonality and the monthly chart segments, and we'll be going back to assessing the current state of sector rotation and in-depth looks at industry groups, single stocks, growth value, international markets and so forth from next week onwards. Ladies and gentlemen, this is Sector Spotlight. Let's start with catching up on the expected seasonality for January 2023. Usually we do this at the end of the previous month, but as you know, that was the holiday season and we didn't have any episodes of Sector Spotlight recorded, so I'm going to squeeze it all in this first episode for 2023. Let's start with a look at the seasonality for the S&P 500 for SPY. And surprisingly enough, the month of January is actually the worst month from a seasonal perspective. If you look at the seasonality chart that we have on the site, you can see that in 45% of the months over the last 20 years, the S&P closed higher than it opened. So that's what you see here. So 45%, only 45% of the time, the S&P closed higher than it opened, which means that in this case, 55% of the time, the S&P closed lower than it opened. So that is a negative expectation. And if you look at the average return for the month of January, that is minus 0.4%. So the outlook for the start of the year is not very good. If you look at the months ahead, then you can see that in general, the seasonality is improving for the S&P 500 in the first, let's say in the first quarter, with the peak in April. Now, what does it mean for the individual sectors? Can we find any individual sectors which are doing particularly well or particularly bad? And as you know, I have a spreadsheet for that I'm sharing with you. And this is, you're probably familiar with this graph here. That's the 3D version of that chart. And when I was preparing for this episode, I actually updated all the data for the sector, so all the percentage numbers with the expected returns, as well as the average returns for each and every month per sector. And while I was doing, because that is actually driving this graph and this table below the chart, but what I found myself doing over the last years since I've been using this spreadsheet is that I was always sort of circling the outliers on the chart. And while I was preparing for this show, I thought, hey, what if I just add a conditional formatting in Excel? And that's what I did here, and I think that's actually a pretty neat way to bring this data to you in a little bit more condensed form and maybe easier to read. I'll leave that judgment to you. Put it in the comments if you've got anything to say about that. But what it tells me, if we go over this table, then here's the data for the S&P 500. So you can see that for SPY, and obviously for SPY it's the absolute price performance. For all the others it's the relative performance versus SPY. And here also in the performance table it's the price performance of SPY, and for all others it's the relative performance versus SPY. But immediately we can see that the expectation for SPY is weak, 45%, only 45% higher, and with an expected negative 40 basis points return. If we go into the individual sectors, that is this line here, then you can see that it's actually materials and maybe discretionary are expected to underperform. They've got a decent underperformance expectation, because as you know, with 35% of the time outperformance, it means that 65% of the time it was underperforming. So materials is the strongest on the downside, with the odds for underperformance being 65%, and especially the expected underperformance, the average underperformance in the month of January is -1% for the materials sector. That's quite a big number. So we're going to look at that sector in a minute when we look at the individual charts. On the positive side, we actually have communication services with 73% of the time outperforming the S&P 500 and an expected outperformance of 50 basis points. And then we have technology with 65% of the time the sector is outperforming the S&P 500. But look at this average return, that's -0.1. So that means that on average, the technology sector in January underperforms the S&P 500 by 10 bips. It's not much. But in 65% of the cases, the technology sector is outperforming the S&P 500. So it means that when the sector is outperforming, it's actually outperforming pretty strongly, because, or not very strongly, because otherwise we wouldn't be able to explain that -0.10 underperformance on average. And then the third one that I want to highlight here is the healthcare sector. 60%, it's not fantastic. I prefer, I don't know, 65, 70 and higher, and 35, 30 and lower to be the real, the real odds that you want to look at. So this is on the edge with healthcare at 60%, but the reason I'm interested is that it is on average outperforming the S&P 500 with 90 basis points. Let's have a look at the individual charts for the sectors that we just highlighted. Kicking off with the RRG on the weekly. So let's take a look at the sectors that we highlighted from a seasonal point of view. And we started with the materials sector being one with the worst expectation. And as you can see, materials is inside the leading quadrant, but it leveled off, it lost relative momentum, or it's flat on relative momentum, but still moving higher on relative strength. That is not necessarily bad, but it is very well possible that because of this starting loss of relative momentum, we will see a weak month for the materials sector. It is absolutely possible for this still to remain inside the leading quadrant and, move ahead and underperform the S&P 500 while still maintaining that relative uptrend for the longer term. So we're going to have a look at that price chart in a second. Now, from the positive point of view, we had communication services. And as you can see, it's still, for a long time already, the weakest sector inside the S&P 500. And it's still moving to the left. The only thing that, if we're looking for positives, the only thing that is kind of positive on communication services is the fact that it is a very short tail. So there's not a lot of power behind it. That means that just like the situation that we had with materials, where it is very well possible for a sector that's inside the leading quadrant and doing relatively well in a longer term trend to lose versus the S&P 500 in the next 3 to 4 weeks, it is equally possible for communication services to outperform the S&P 500 in the next couple of weeks while still maintaining its relative downtrend and remaining inside the lagging quadrant on the RRG. Then we have the technology sector, and if we look at that one, you can see that is inside, or it's just moving from lagging into improving. which is underscoring the positive take that we get from the seasonal pattern. So we'll have to look at that. The only thing that's holding me back here is the weak average return over the last 20 years for the month of January. But if it all balances out, I would say that maybe technology is in for like a flat month. We're going to have a look at the chart, but it's not picking up on relative strength yet. It's an almost vertical move, which means that it is picking up a lot of relative momentum, but that relative momentum has not translated into relative strength yet. Very well possible, but we'll have to wait and see how that pans out. And then finally, we have the healthcare sector, XLV, which is already inside the leading quadrant. This sector lost a lot of relative momentum over the last few weeks, but is still maintaining its relative uptrend. And with the expected positive return, expected outperformance for the healthcare sector in the month of January, this definitely might be one of the more interesting sectors. But again, we're going to have a look at the price chart in a minute. The average outperformance for the healthcare sector in January is 90 basis points. That's a number worthwhile looking at. So let's have a look at, let's start with communication services here. So that's one that's in the positive section. If you look at this price chart, we are holding above the previous week's lows, but it's not I don't think it's a particularly strong sector from a price perspective, and also from a relative perspective, that trend is still moving lower. So I'm not gonna make a fantastic call on the communication services sector being a strong outperformer of the S&P 500. I'm not sure whether what's actually happening on the price chart, the position of XLC on the RRG, and the expected returns are worth putting on a lot of risk on that case. If you look at technology, that's kind of similar. Here, that downtrend still very much in place. We have seen, or we're seeing, that improvement on the RRG, which is predominantly caused by that improvement in relative momentum. As you can see, relative strength, RS ratio is still flat. So again, despite the fact that it is very well possible for technology sector to pick up a little bit in terms of price and maybe also in terms of relative strength, the odds are not fantastic. If you look at the position on the RRG, if you look at the price trend, if you look at the relative trend, all of that is not really confirming the positive stance that we're getting from the seasonal readings. So again, for both communication services as well as technology, the seasonals are kind of okay, but I don't think it's confirmed by what we see on the RRG and the price charts. That's different for healthcare. If you look at the healthcare position on the RRG, it's inside leading, but it's losing momentum. As you can see here, that's that loss of relative momentum. That's the green decline here. But the trend, the relative trend, is definitely upward. And so is the price trend. We're actually pushing against overhead resistance between, let's say, 140, 141, 142. But we're holding up above that old resistance that's now acting as support, while relative strength's actually on its way. We took out these previous highs, but we're now challenging the high here of 2020, kind of above it. So that is definitely a good reading. So for XLV, we have a strong seasonal expectation, not the strongest, but definitely a strong one. We've got a high expected average return of 90 basis points, and we've got a price chart that's actually holding up pretty well, especially if you compare it to the other sectors. And the tail is still inside the leading quadrant on the RRG. So for the healthcare sector, I am definitely watching an outperformance and a good performance in the month of January. And then on the other side, on the negative side, we've got materials. As you've seen, materials is inside the leading quadrant, but that tail was rolling over. We got a negative reading from the seasonal patterns. And if you look at the chart here, then you can see that we bounced off that old support that came back as resistance. We tried 1, 2, 3, 4, like 6 weeks. And 2 weeks ago, we really dipped. And we're not able to really come back fast. And even if we do, that old support now acting as resistance is very likely to cap the upside potential, while the downside is now opening up again. And if you look at the relative strength, that you can see that the relative strength line didn't reach the resistance line, and we're at relatively high levels compared to history. So all in all, it looks as if materials needs a little bit of another rotation before we can actually go higher, and that is in tune with the weak seasonal expectation as we've seen it from that seasonal chart. So wrapping it up, I think that the best expectations or the best odds are for underperformance in the materials sector and outperformance in the healthcare sector. Let's start with the monthly charts of asset classes for asset classes. And now that we have the monthly data available on our relative rotation graphs, it makes sense to have a quick look at the relative rotation for the various asset classes on that monthly time scale. This is, remind you, this is super long term. This is not for trading. This is just to give you the super high level overview of what's going on. Let's start with the relative picture. So here we've got all the asset classes that we're tracking versus VBINX. That's our balanced index fund. And as you can see, the clearest message is for Bitcoin or crypto in general. Strong underperformer for many months with a very long tail. I'm going to switch this off to get a better handle on what's going on with the rest of the asset classes. And that what you can see here is that commodities are still the highest readings on the RS ratio scale. But for a couple of months already, they are losing relative momentum. And I believe that that should change rapidly to keep up that long-term outperformance, that long-term trend for commodities. US dollar is, after a very long stint of outperformance, starting to lose relative momentum, but I think what most people are looking at, what most people are interested in, including myself, is the relationship between stocks and bonds or stocks and fixed income. And what you see here is that the monthly tails for SPY is inside weakening and heading towards lagging, while all three fixed income related asset classes are inside improving, and they're kind of heading towards leading. The only one that's bending over is high yield, but corporate bonds and government bonds are still moving to the right, higher on the RS ratio scale. Now, if we change this chart, this RRG, to use $1 as the benchmark, which means that we're looking at price trends, we're looking at absolute price trends. There's nothing changed for Bitcoin. That's still the worst chart out there. So again, let's take this off and see what's going on. And now it becomes interesting because what you can see here is that both SPY, or both stocks and fixed income related asset classes, are in a downtrend or very close to it. And again, this is very long-term stuff. So just a high-level overview. But the interesting thing is that both asset classes are going lower. The only difference is that if you looked at the relative version, that the fixed income stuff is kind of beating stocks on a momentum scale. If you look at on the right or the left, then SPY is still at a higher RS ratio reading, which in general is positive, but they're coming closer together, which means that they're kind of balancing out. And that translates into all these tails moving left, meaning having a more of a price downtrend than anything else. Again, the dollar and the commodity tails are where they are with a warning signal. Let me put it like that. Quickly look at those, a few of those individual monthly charts. Government bonds in general still in a downtrend, pretty strong downtrend actually. That also translates into IEF, which is the 7 to 10 year segment on the yield curve, probably the most important. And that just bounced back to that old support level now, acting as resistance, and we closed the month at the lower end, so not a lot of good news there. And then we have corporate bonds doing pretty much the same, just touched that old support level now, acting as resistance. You can see high yield didn't even get there. So again, you know, out of that range, coming lower. And then we've got commodities, and DJP and GSG, they're both, you can see that, they're both touching that rising support line. So I think that the month of January, maybe Q1 is going to be pretty crucial for commodities as an asset class to prove whether it is ending that little dip after turning around, or is it all over, or will we be seeing a new move lower in commodities? I find it a hard call, but given this long-term base here, I'm more biased towards commodities putting in a low and starting to move higher somewhere in Q1 of 2023. And then finally, the US dollar, that is dipping below its first support level, but as you can see, these are two extremes that were set around that 104 level. More serious support is around 101. I would expect the dollar index to stop around that 101 level, put in a new low, and start to move higher. But that's going to take a couple of months at least. And we're going to wrap up this first episode of Sector Spotlight for 2023 with a look at the monthly charts for sectors. And I want to start with the table that we usually do at the end of the show, pretty much because I know that I'll probably be not enough time to do it at the end, so we're getting crushed on charts instead of the summary, so I'll give you the summary first. As you can see, the month of December was pretty weak, with all sectors in the negative, S&P down almost 6%. And if you look at the trends, then there's only one sector in an uptrend, and that's energy. And in a downtrend, we have communication services, discretionary, technology, real estate, and the S&P as a whole is also in a downtrend. And if you sum all of that up, then we come to the conclusion that almost 47% of the market cap, I have to say, not percent of sectors, but 47% of the market capitalization is in a downtrend, and only 5% is in an uptrend. And if you look at the, and these are pretty arbitrary, subjective levels that I have picked, and you can find them on the charts because the chart list that we use for this segment is a public chart list. We'll put the link to that chart list in the description of the video. But you can see that in general, the downside risk is bigger than the upside potential. And I think that is the story of the market right now. There is a bit of upside potential, but the downside risk is just way too big. It doesn't outweigh the potential for profit to the upside. So I remain very, very cautious with stock sectors in general. If we take a quick look at the relative rotation for these sectors, then we can see that energy remains an outlier on the positive side. And in the lagging quadrant, we've got communication services, we've got discretionary, and we've got technology. There's a cluster here around the benchmark, that's financials, real estate, materials, and to a lesser extent industrials. And we've got healthcare, staples, and utilities inside the leading quadrant, with a little loss of momentum for utilities and staples, but they remain the stronger sectors. If we do the same trick as what we did with asset classes and put that against $1, then looking at the price trends for these sectors, then we can see that that pretty much matches our table. We've got energy in an uptrend, still inside leading. We've got communication services, consumer discretionary, and technology, all inside the lagging quadrant. Those are the ones that are in downtrends. And then we've got a whole bunch of sectors that are inside weakening, but they're all at a negative heading. So the overall picture from a price perspective on the monthly charts is just not all that, still not. Let's start with the individual charts for the S&P 500, because I didn't look at it in the asset class section because I knew I was going to deal with it here when we were talking about sectors. And as you can see, we touched that old resistance, now support, we bounced, but the series of lower highs and lower lows is still intact. So it remains in a downtrend for the S&P 500. Here we've got communication services. That downtrend is still very much visible. And the same goes for the consumer discretionary sector. As a matter of fact, consumer discretionary just last month dipped below the previous low and back below that former resistance, then support, and now it will start to act as resistance again. So that's a real negative signal for the consumer discretionary sector. And then if you look at technology, then you can see that that rhythm of lower highs and lower lows is still present, so that remains a downtrend for consumer discretionary. If we move to the only sector in an uptrend, that's the energy sector, and you can see that that rhythm of higher highs and higher lows is still there. In November, we actually peaked above the previous high. We still haven't taken out the all-time high. Last month was a weaker month, but we closed, as you can see here in the thumbnail, around the middle of the month, so that's kind of okay. And I'm actually looking for this sector to push back up and maybe move beyond that all-time high in Q1 of 2023. And then finally, we have here the Consumer Staples Index. And I picked that one because that chart is actually improving. You can see that we're pushing against overhead resistance there. We kind of managed to stay in that rising channel, one dip below, but now we rapidly went back up, and we're pushing against 805, 810 as resistance. If we take that out, we're absolutely on the way to 850 for consumer staples. And finally, we've got the healthcare sector, and that's maybe the best sector at the moment from both a relative perspective and a price perspective. As you can see, on the price terms, we came out of that consolidation, we held up above that previous high, and we're looking to push beyond 1650, 1660, which brings the healthcare sector to new all-time highs. So that's it for the monthly charts. And that wraps up the first show for this year. Thank you for watching. Please remember, Sector Spotlight airs every Tuesday, 10:30 to 11 a.m. Eastern on StockCharts television. And of course, you can also catch the replays on YouTube or any of the on-demand channels. I'm looking forward to seeing you again next week for a new episode of Sector Spotlight. Same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.